I now hand the conference over to Mr. Sumit Kishore from Axis Capital Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Good afternoon, ladies and gentlemen. On behalf of Axis Capital, I am pleased to welcome you all for the IndiGrid Trust call to update and discuss recent acquisitions in transmission and solar sector. We have with us today Mr. Harsh Shah, CEO and Whole-time Director of IndiGrid Investment Managers Limited, representing India Grid Trust on the call. He is accompanied by Mr. Jyoti Kumar Agarwal, CFO, and Ms. Meghna Pandit, Head M&A and IR at IndiGrid. We will begin with opening remarks from Harsh on strategy and subsequently on the deal. This will be followed by the Q&A session. With this, I hand over the floor to Harsh. Over to you, sir.
Hi, thank you, and thank you everyone for joining the call today. To start with, wishing you all, a great year end and wishing a happy new year for the next year in advance. Today we are gathered here to discuss a couple of updates on the business that we have recently looked to acquire. So we believe that it is something new that we have done, and therefore it is essential to have a call and explain on how this fits into our overall strategy. To start with, I'm on slide number 4 to reiterate our vision. Our vision is to become the most admired yield vehicle in Asia by keeping our focus on a focused business model, value accretive growth, predictable distribution, and optimal capital structure. As you would have seen in most of our business and actions, we have kept these 4 principles in place, and most of our business strategies we do is on these principles to ensure that fit into our overall game plan. The next slide is a quick snapshot about our size and scale today. We are approximately 14,000 crores in AUM as of September, and our presence is in 14 states and 1 UT in India. We own 28 lines and 9 substations for approximately 6,000 kilometers and 11,000 MVAs. We are rated AAA by all 3 key large rating agencies, and the residual contract life is still 32 years. We own approximately 9,800 towers and having a sizable amount of metal in the portfolio. As you would have gone through certain press releases, our primary focus is to acquire operating projects with long-term contracts, low operating risks, and stable cash flows. I believe both these acquisitions that we have done is fitting that criteria, and both of them are new because neither are they from our sponsors or not just TBCB projects. So both of them are unique in its own way. I would invite Meghna, who looks after M&A and capital raising for IndiGrid, to brief on the slides from slide number 7 onwards on both acquisitions, and subsequent to that, we would go towards a Q&A session. Meghna, over to you.
Yeah, thanks Harsh, and welcome everyone on this call. So the first acquisition that we have captured in the slide is on page number 7, which is Parbati Koldam Transmission Company Limited, wherein we have signed definitive agreements for acquiring 74% stake. This project was awarded on a build, own, operate BOO basis by the Ministry of Power, and it is in a joint venture between Reliance Infra and PGCIL. PGCIL owns 26% in this SPV. Another unique feature about this asset, this is a Section 62 asset, which means that it was awarded on a cost plus tariff mechanism. This will be the first asset that IndiGrid is acquiring, which is of a cost plus nature. It has been operational since November 2015, so a great operational track record that we have seen. Totally, in this project, if you look at it, there are about 2 tariff generating elements spread across totally 458 circuit kilometers. Again, this project is a very critical project for evacuation of power from hydropower projects of Parbati 2 and Koldam, which connects with the downstream transmission network in Punjab. This being a build, own, operate project, again, the contractual life of the project is about 35 years, which is in line with most of our other projects which have been awarded on a TBCB basis. Again, from a tariff perspective, it forms part of the point of connection mechanism, wherein the central transmission utility, which is PGCIL, acts as a CTU, and through a pooled account mechanism, the tariff gets distributed. I think, as Harsh mentioned on the call, this acquisition fits in very well with our stated strategy of looking at assets which provide long-term stable cash flows. This is a fixed return project, as I mentioned, since it was awarded on a cost-plus basis. So a fixed ROE of 15.5% is provided through the tariff regulations by CERC for the period between FY19 and FY24. On the operational performance, we have seen that all throughout there has been annual availability of more than 99.5%. It has been constructed by Tier 1 suppliers of Kalpataru, KEC, and the likes. Going on to slide number 8, just a few acquisition details that we have provided. The SPA we executed in last week of November. The total enterprise value for this project works out to about 900 crores, and it is subject to customary closing adjustments with respect to the cash balance, the net current assets, etc. The acquisition is also subject to customary regulatory approvals, including from PGCIL, from the existing project lenders, and with currently underway on completing the conditions precedent, we are expecting that the transaction will get consummated by Q1 of FY21. We do not envisage any equity dilution or acquisition of this project. We had raised about 2,500 crores last year through the preferential allotment. So those funds plus the available debt headroom and the internal approvals will be utilized for funding the acquisition of this project. Slide 8, last table provides for the average line availability and the broad estimate of revenue and EBITDA for FY20. Moving on slide number 9, we had come out with, in April 2020, we had taken unit holders approval for our diversification strategy, which was to enter into, renewable sector by acquiring operational solar projects. So broadly, slide number 9 talks about how are we looking at this diversification strategy. So the assets that IndiGrid will look at in the solar sector will comprise of assets which have a long-term contract, which have minimal counterparty risk. So we will focus only on counterparties like SECI, NTPC, GUVNL, which will again have some track record basis which we will be looking at acquiring them, as well as again look at the quality of the project in terms of whether the tier 1 equipment suppliers have been sourced on implementation of the project, how robust is the infrastructure, etc. With that focus and with that strategy in mind, we have gone ahead and acquired entered into definitive agreements for acquiring about 100 megawatts AC capacity of 2 solar PV plants from an entity called FRV, Photo Ratio Renewable Ventures. This is a Spanish entity and has a track record of developing about 5 gigawatts of projects across solar projects across entire Europe, US, Middle East. This project per se, the 50 megawatts, is placed in 2 SPVs, and the PPA they have have an operational history of about 2.5 years. The tariff for the project is fixed at 4.43 per unit with about 44 lakhs of VGF per megawatt. From a connectivity perspective, they are directly connected through a PGCIL substation that is about between 3 and 8 kilometers for T2 and T8. As I mentioned, the assets were commissioned in July 18 and have a track record of around 2.5 years. The existing lenders to the SPVs are again reputed lenders of IFC, FMO, and IRDA. As far as the equipment suppliers are concerned, the modules were provided by Trina and Longi, which form part of the tier 1 category. Inverters are provided by SunGrow, and the EPC contracts have been turnkey EPC contracts were done by Sterling and Wilson. So an important feature to talk about this asset is, the assets in FY20 have generated about 200 million units, which basically means that they have ended up saving about 160,000 tons of carbon dioxide emissions, which is equivalent to carbon dioxide absorbed by 76 lakh trees. Again, moving on to slide number 11 on the acquisition details. The definitive agreements were executed just about a week back. This will be the 11th potential accretive acquisitions after listing and after we acquire PKTCL also. Like for PKTCL, we are not envisaging any equity dilution for acquisition of this project, and it will be funded through the preferential issue proceeds and the existing debt room and internal accruals. For these projects, the enterprise value comprises of 660 crores with zero cash and zero receivables. As I mentioned, there is sufficient debt headroom which is available, which will be utilized. The table on the slide provides the plant and the grid availability, which are key metrics which we typically look at in solar projects. As you can see, the plant and the grid availability have been very robust since COD, more than 99.5% in both the plants, with the revenue and EBITDA being about 97 crores and 86 crores respectively. Moving on to the next slide number 12. Broadly, if you look at both, after acquiring both these projects of PKTCL and FRV, we expect our AUM to increase by about 12% from existing 14,000 odd crores to 15,500 odd crores. The net debt to AUM, which currently stands at around 54%, after acquisition of these projects will be about 58%, leaving sufficient headroom for acquiring our framework assets of NER and KTL from Sterlite Power, which we have already announced. The annual EBITDA for both these projects that we are estimating is close to about 225 crores, and the estimated annual NDCF accretion on both these projects will be in the range of about 40 to 50 crores. If you look at the right-hand side map of India, as you can see, we have a great geographical diversification with the existing 11 projects, plus the addition of these projects will just add on to it across the northern region, as well as with the solar assets in the southern region. So with that, I think we will end the presentation and the submission from our side, and I will request Sumit to open the discussion on the Q&A from the investors, please. Thank you.
Rutuja, can we please take the first question?
Thank you very much. So we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Kumar from DAM Capital. Please go ahead.
Yeah. Good afternoon. The two questions. First is on the first, congratulations on the completing on entering the agreement to acquire both the assets. Two questions. First is on the tariff. I think tariff is 4.43, which is fixed for 25 years. Is there any dispute on the tariff with AP? Are we being paid half of the amount? And what is the receivables outstanding? And is there any adjustment we need to pay over and above that once the judgment comes in? That's the first question. Yeah.
Okay. So thanks, Mohit. The first question that is pertaining to solar, I believe, on FRV side. So while this plant is physically located in Andhra Pradesh, but this is a SECI contract. So our counterparty is SECI. And therefore, at this moment, there is no litigation or any outstanding matter with Andhra Pradesh. So there is no issue or tariff withheld or reduction of any kind. there is no dispute. Our receivables are in the line of approximately 75 days, which is at the market with SECI payments. And SECI publishes the payment track record publicly for all Gencos, right? And one can check that. Until now, there's been a 100% payment track record by SECI and without any delays. So while physically this plant is located in Andhra Pradesh, the location is good because of irradiation. The contract is with the central sector counterparty.
Okay, understood. Secondly, what was the capital cost excluding VGF? What is the capital cost of this to setting up this power plant, FRV?
Okay, so Meghna, do you want to answer that question?
Yes. So the project cost for the projects for both the plants put together was close to about 650 crores.
How much?
650 crores.
Okay, understood. And on the Reliance Power coal down transmission asset, last time, of course, it was supposed the asset the acquisition failed. I don't know the exact reason. So, is there something when do you expect this transaction to conclude, and do you see any hurdles, in completing this acquisition? And what happened last time exactly? Why this fell through?
So, we can't comment on somebody else's.
No. I understand there was some procedural issue, right? That's the reason I'm asking.
Yeah. So procedurally, what we can say is that this asset is a joint venture with Power Grid, and till the 5 years from commissioning, if any sale of this asset were to happen, Power Grid had a right to say no. Okay. And therefore, probably it didn't happen because of that. This 5-year lock-in completed on 3rd November 2020, and our agreement got signed after that. So in such scenario, the SHA with Power Grid in the joint venture provided them right of first refusal. However, they do not have right to say no. Right. So that is the difference probably is there between the two timelines. I think that's what we believe could have happened.
Understood. Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, Harsh and Meghna, and thanks a lot for taking my question. So first question, if you can comment on the project and equity IRR for these two transactions for the stake that we have purchased for PKTCL and for the full asset on the FRV.
Okay. So, Sarvesh, thank you for the question. For any new acquisition, we look at different metric, and for this case, also both these assets are of different nature. So we'll try to describe how one can look at it. Starting from PKTCL acquisition, which is unique because it is a cost-plus asset. Over here, more than IRR, we are looking at it as a dividend play, and one can look at it as a dividend discounting model as well. So this project has approximately 275 crores of equity, which is regulated equity, on which the project earns approximately 15.5%. There are obviously certain minor adjustments both on up and down. So one can take 15.5% as a regulated return on the equity base of 275 crore. Right? That's the more or less. So now, if this is the dividend that is accruing to us, right, as a project, this dividend is post-tax. So we can actually take this amount and upstream to IndiGrid as a dividend payable, and IndiGrid can provide to investors as a dividend received, on which investors will not have to pay tax because the SPV is in the old tax regime. So we use, I would say, this dividend is kind of a perpetual dividend that we receive out of this asset, and therefore the right metric to look probably would be a dividend discounting or a dividend multiple method.
Understood. You acquired this at price to book of 1?
No. We have not acquired at the price to book of 1. We have acquired at price to book of approximately 1.5. So if 15.5 becomes a 10.5, and with a little bit of leverage headroom that we have, we can increase it further. Right? So on an unlevered basis, if you were to look at it on an unlevered equity base, because there's an underlevered project right now, we earn approximately 10.5 to 11% dividend, right?
And this will be tax-free if you declare dividends on this.
Correct. Now, I'm not commenting on complete tax-free nature, because if somebody were to receive more than 10 lakh rupees of dividend, probably it's taxable in their hands, right? In whichever tax regime you are. But this is an old tax regime. So one were to say, in old tax regime, the dividend will be tax-free in the hands of investor.
So this is a bit different because this is tax-free at 10.5 versus maybe 12%.
So again, 10.5 is unlevered. So with just the 10-15% extra leverage more than SPV, we increase it to substantially higher, right? So that's the, I would say that's the right way to look at it. In addition to that, as you know, this is not a I would say this is not a acquisition which is necessarily requiring us to do capital raise. So the entire amount is coming on the same equity base.
So you will pass this on as dividend, not as interest.
Yes, that is correct. We are not yet acquired, but that is correct. Directionally, the unique aspect of this asset is also that we will be able to pass through the dividend as dividend, not as interest.
Okay. And if we just do 2 by 9, I mean 2 billion of EBITDA divided by 9 billion of enterprise, that looks to be on the higher side. So what am I missing here?
Sorry, what is 2 by 9? Can you repeat?
That EBITDA of 2 billion divided by 9 billion of enterprise.
No, important question. I think we have given the 200 crore EBITDA as a matter of fact representation. This also includes depreciation payment. In a cost-plus project, typically your depreciation payments are also paid as part of your EBITDA, right? And therefore, in the initial years, you have a very high EBITDA, and the later years, you have a fixed dividend coming out of the project. So which also provides us opportunity to actually optimize further for better IRR, right? In addition to that, this also includes one-time revenue of 40 crore, which is received in, one-time revenue is booked on account of change in COD for the earlier three elements.
Understood. And can you just comment on FRV IRR as well?
Correct. So FRV, again, IRR is a function of leverage and cost of debt, everything put together. But I can give you directionally, we have acquired it approximately 7.25 to 7.4 kind of EBITDA multiple, right?
Yeah.
And that at our cost of debt and our leverage would result into a even if we were to assume a reasonable leverage. So basically, it's far more attractive because of the multiple. I think multiple is a better way to look at this asset. So IRR would result into a substantial accretion from what we are right now. But I don't want to give a specific number. Multiple is something which is easy to communicate in public.
Yeah, and Meghna commented that the project cost was almost equivalent to the enterprise value. So now this came in 4 years back, and interest costs have substantially declined in the market. So how are we able to get it at the similar enterprise value as the project cost 4 years back?
Okay, very good question. We first of all, we have been working on this asset for about a year, and our values were locked much earlier. So as per the contract, we have locked in this asset very early on. Second, as such, we are not really linked to the capital cost of the project. We are largely in terms of how do we value a particular project based on the ability to earn cash flow. And as we have seen it in the past, we have acquired projects at a below market price, below capex cost also, and above capex also. So as such, we don't really, I would say, consider the capex amount on account of, if they made a higher cost or a lower cost, right? That's not our prerogative. How we have acquired, I think that's something which is based on our, I would say, competitiveness, that we are able to provide a, I would say, a swifter solution, a better solution, right? That's the way to look at it. And again, this project had a VGF, etc. So overall cost, etc. makes, approximation slightly more complicated, right? To link directly ki itna kiska kitna cost hona chahiye tha. So.
Okay. And since for solar assets, the problem was the possibility of volatility in the cash flows as opposed to our usual stuff that we do. So what has been the volatility in the last 3 years, FY 18 to 20 for this asset? If you can comment on that volatility.
In terms of? Sorry.
In terms of the cash flows that will accrue to you, I mean, for the solar assets, the possible problem is there can be a volatility as opposed to a fixed revenue, which is independent of everything, right? Yeah. In your usual business.
Yeah. So we have at least good that this project has a 2 year of history, and this project has also several other hundreds of megawatts around in the solar power plant, and we have seen that the grid availability has remained more than 99.8, 99.9, so there are no issues, and it's a very small line which is connecting to a large substation. So grid availability has not been an issue at all. Plant availability, I think first 3-4 months, obviously there is a settling period, but last 18 months have been phenomenally good. So I would say not operational, not technical, and not collection. I think none of the parameters we have seen any surprises or volatility in this plant.
Okay. And my final question, if I may, now these are like 500-600 crore assets that we are acquiring. I wanted to know, now that we have built some sort of a platform, what is the advantage that is coming to us as a platform as opposed to, let's say, a family office which wants to buy, these sort of asset at 500-600 crore, because these are not very large amounts for Ultra HNI or even other firms to sort of try to buy, especially when the yields are coming down across the board. So are we getting some advantage now because of the platform? And if you can quantify it a bit.
Yeah. So let's say you are a large HNI of 500 crores. Would you buy a listed instrument which you can sell any day and have a tax advantage versus buying a physical asset which you need to run every day and figure out how you are going to run it, right? So, I mean, that's the first question. It becomes a no-brainer that when the scale comes, the benefit is that we are able to deploy the right kind of resources behind it, right? Whether it's in terms of people or in terms of managerial or leadership bandwidth or in terms of technology. Right? I'm sure you would have read about recent partnership with IBM that we did for our portfolio. Now, that's a sizable capex. You couldn't have done that in a 1, 2, 3 portfolio asset size. So with scale, the advantage comes in terms of reliability of asset, predictability of asset, because you are able to deploy right amount of technology and resources on that. And the third one, which is overall reduction of O&M cost, right? Because we are having the scale. That's, I would say, called an operating synergy. The next synergy exists for us on account of, I would say, financial synergy. We are AAA, and I would say we are one of the few, if not only AAAs in the country with having a AAA rating and acquiring renewable energy asset, right? So we do have, I would say, cost of fund advantage. And the third one is just structural advantage. We have framed as an InvIT, and which allows us to extract all the cash and provide it to our investors, right? Which for some investors is preferred, and therefore, overall we are able to provide a better outcome because of these 3 parameters.
Understood. Your NDCF accretion for the last 4-5 acquisitions that you have announced will be around 100 crores cumulatively, 40-50 coming from these 2 only. So that is like 1.5 rupees per unit. So what is the plan now? Is it more acquisition with this or increase of DPU? How are you thinking about that?
Yeah. So, sorry, I think a right question. We are waiting for the year to end, right? And we need to take stock of what is the NDCF the full year basis. In any case, we have to distribute minimum 90% at both SPV and IndiGrid level. These acquisitions would happen in Q4, so may not yield materially in this financial year, right? These numbers are annualized, not quarterly. So we'll have to take a decision in Q4, and the board of the manager and us will decide what is the right set of DPU based on the NDCF, and we'll come with a plan in probably Q4 meeting. Because we have just come out of COVID. I would say the first 2 quarters we are discussing about preserving cash. Now suddenly there is a turn in events and markets have become far more liquid. So we would like to just see the full year catch up. How does that become before we, I would say, increase the DPU. If at all our NDCF becomes materially large, we anyways have to do it.
Yeah, so that's the question. The 90% of these annualized cash flow for all the assets that have been announced till now, is that greater than 12?
Not no, because these assets will going to come in quarter four. So
No, the annualized number next year. I'm not talking.
yeah. So maybe next year there might be a compulsion to do that, right? So,
Understood. All the best, Harsh. Thanks a lot. Thank you for all the questions. Thank you.
thanks.
Thank you. The next question is from the line of Abhilasha Satale from Dalal and Broacha. Please go ahead.
Thank you for taking my question. Sir, we have fixed the tariff at 4.4. However, we are seeing most of the solar, the tariff, the recent solar tariff are below. Even the recent one, which this has backed, NTPC has backed, it is below 2 rupees. So, do you find any threat of the tariff going down, in future or anything of that sort of this thing is there in this contract?
Yeah. So, Abhilasha, I think it's an important question. We evaluate from a perspective when you are acquiring that is this materially higher than APPC of the state or counterparty. In this case also we are not materially higher than APPC. So I don't think we can evaluate contracts from, or other contract sanctity from incremental cost, right? Because by that logic, a lot of capacity in India would have become redundant, right? So the way we see it is incremental cost of electricity of solar will come down. But on the other hand, if you have a reasonable cost of power, in that scenario, we suspect that these contracts will be renegotiated. They are very fairly strong, clear contracts, and they are with credible counterparties like SECI. So we don't see that as a risk. Historically, there have been such attempts by even Gujarat, a state like Gujarat, with a tariff like 15 rupees, and it hasn't succeeded, right? So we believe the regulators and judiciary is fairly clear on this point. And if a state asset with a state PPA with a 15 rupees kind of disincentive had to eventually pay and are still paying, with a central counterparty with a 4.5 rupee, we don't see it as a risk for the business.
And what is our current debt level, and what will be the debt level after these acquisitions?
I think the debt level after these acquisitions was there in the presentation, approximately 58%.
Yeah. Okay, thank you.
Thank you.
Thank you. The next question is from the line of Varun Agarwal from BOI Exam Mutual Fund. Please go ahead.
Yeah. Hi. So my question is around the strategy of going forward, increasing the share of renewable energy in our portfolio. So what kind of impact it can have on the overall IRRs and dividend distribution and our overall asset profile?
Sorry, can you repeat that question, please?
So, am I audible?
Yeah.
Okay. Sorry, I repeat my question. So I wanted to understand the overall overall strategy of increasing the renewable energy assets, which is solar and other assets, or generating assets in our portfolio. So what kind of impact it can have going forward on our dividend payment, IRRs, and overall asset profile?
Okay. So, one can look at it from different angles, whether it's from a risk perspective or return perspective, but I'll try to address it on both. One is the solar assets which we are acquiring, even central counterparty assets, are going to be more accretive, right? So they're going to be higher returns. So as I said, we acquired it for 7.5 kind of EBITDA multiple, whereas transmission assets go at least 10-15% higher, so about 8.5, 9 kind of multiple, right? So there is a difference in terms of accretion that happens. On the other hand, there is also slightly higher risk, right? Because there's a point of connection mechanism pool for transmission assets, which has got a far longer track record, versus what we are acquiring from SECI NTPC that has a relatively shorter track record. We believe the contracts are equally strong. However, as a part of our strategy, we don't follow a particular mix, right? That we want to be 20% renewable or we want to be X% something, etc. Our focus is to, as I started with the presentation, to find assets with long-term predictable cash flow. Right now we've identified as a solar as an area. Maybe we may get good acquisition opportunity. Maybe we don't. Right. So there is no set pattern that we need to follow, and therefore I think we are neutral to a percentage. However, as a guidance, we have been telling investors and debt participants as well that at no point in time we are looking to cross solar assets or a portfolio of 20-25%. Okay? So that is an outer cap. Doesn't mean we have to be at 20-25%. We may be at 15% and still be happy. So our focus is on managing the risk by selecting the good quality asset with good counterparty and ensuring that they are accretive. After that, the percentages is not something which is part of our business plans.
Okay. Thanks, Harsh. So one more question on the similar line. In terms of the predictability, a lot of these solar assets might have variability in terms of the availability of sunlight and other things. So do you think this between 20% exposure will have too much impact on our cash flows, considering till now most of our assets are more or less
important question. I think the way to look at it is twofold. One is solar as a resource is not as unpredictable. Right? I mean, you can solar started in India on a commercial scale somewhere around 2007-8 period, right? So in most of the solar generating stations, or rather let's say regions, there is more than a decade of solar data available. Right? So the solar generation or irradiation per se is not materially variable. Right? So that's one point. Second point, and right now we are looking just one asset. But let's say if at all we are at 15% to 20%, we are not looking to buy it in one area, right? So maybe you have 5% capacity in Andhra Pradesh, 5% capacity in Rajasthan, maybe 10% capacity in Gujarat. We don't know that. What solar offers as an opportunity is a diversification. So you are not concentrated in a particular geography, which will hit you hard if there is one suddenly there is a higher rain in that year and you are kind of impacted. So it's not a concentrated capacity; it is a distributed capacity in relation to scale, and therefore we don't get material impact right on that account. So solar that way gives diversification, and the impact is lesser. Vis-a-vis transmission, and I'm not kind of saying the transmission is more risky, but kind of a concentrated impact, right? If our one line is 10% of our portfolio and is down for 1 month, will have a far higher impact on our balance sheet, P&L, than one solar plant having a little bit of less generation on account of higher rainfall, right? So it's not it is not really adding that much of risk on account of solar irradiation, right? Does that help the question?
Yeah, absolutely. So just one last question. In terms of the in terms of the payment pattern, we don't see any issues in terms of solar assets. And as we have already mentioned, we are focusing more on SECI and all central government or when assets which you're buying are more linked to where there is a predictability of cash flow. There will be so that the cash flows itself are not delayed.
Right. No, so I think let's not club all solar generation into one bucket, right? We are buying solar assets with very select counterparty. Right? That means SECI and NTPC, which exactly addresses the risk that you are trying to address.
Understood. Thanks a lot. But that's it from my side.
Thank you.
Thank you. The next question is from the line of Hansal Thakkar from Lalkar Securities. Please go ahead.
Yeah. Hi, Harsh. Hi, Meghna. Congratulations on the last two acquisitions. Just one question. Can you throw some light on the cost of debt on the last two acquisitions and then on the portfolio in general?
Yeah. So thanks, Hansal. And this question keeps coming. It came in Q2 review also because the cost of debt in the market in general has come down materially. And optically, our cost of debt, ticks at 8.5%. We believe in kind of conservative management, so we have been fixing our cost of debt in the past, and therefore a lot of instruments are fixed. However, approximately 40-odd% of our balance sheet debt, approximately 8,000 crores, we can either refinance or prepay or some kind of other structuring way we can do, and we are working on that. For example, we raised recently, just about a month back, one non-convertible debenture at a cost of debt of 6.85% quarterly on a 3.5-year period, right, which is about 7% annualized. And today we have opened up another issue for the upcoming acquisitions, which is at 7 to 7.2% PAPQ, which is approximately 7.25, 7.4% annualized for 4.5, 5-year maturity. So I would say the transmission is happening. The substantial reduction is happening. This is approximately 125 bits lower than our weighted average cost of debt. We are looking to refinance assets, and as and when we do, it will result in benefit on that account. And this, especially the capital that we are raising now, is going to go towards the acquisition that we are doing right now. So for refinancing, we will keep, focusing on opportunistic, I would say, tenor as well as facilities that allows us to reduce further.
Great. So as I understand, the FRB acquisition was done on 100% debt, right?
FRB and PKD, both are not done yet, but
as in they will be done.
We're underlevered right now. Will be based on debt. We'll be funding the acquisition at debt.
Brilliant. Wow. So that's a really lucrative acquisition then. And some idea on the PLF on the FRB? Would you have that handy by any chance?
I think we can give you a little bit of past data.
Sure.
So the generation is in the tune of approximately 20 crore units. So that comes to approximately 18 to 18.6%. Let's call it 18.5% CUF. But this is on a DC capacity. Okay, so the DC capacity of the plant is 137 megawatts. 135 megawatts, not 100. So if you were to try to calculate the math, it comes from 135 megawatts multiplied by 18.5% multiplied by 365 into 24 into 4.43. That's the calculation. But if you need to consider DC capacity.
Okay. And the 4.43 you are mentioning is without the VGF.
Yeah, VGF is actually, VGF is a one-time payment that gets paid when a particular milestone is achieved. Right? And in this case, some of the milestones are not yet achieved. So they will be paid over the period of next 12 to 24 months as and when, those milestones are achieved by the plant. And part of this, we will have to share with FRV as an earn-out. However, some part of it will also result into our accretion, which is additional to, what we are making right now.
Okay, so keeping the VGF as a one-time, it would be safe to assume that the rate per unit will still be 4.43.
Oh, yeah. 4.43 is annual payment. VGF is just one-time grant that gets paid.
Phenomenal.
Not one time. It comes in 4 tranches, 50% on first year in COD and then 10% every year. So in first 5 year, VGF is get paid. So VGF is over and above this.
Okay, brilliant. Great. Thanks for the clarification. Congratulations and all the best.
Thank you.
Thank you. The next question is the follow-up question from the line of from Mohit Kumar from DAM Capital. Please go ahead. I'm sorry, his line got disconnected. We have the next question from the line of Sunil Kothari from Unique Investment. Please go ahead.
Thanks for the opportunity. Our congratulations for these two new acquisition and sustain. So it's really commendable. So my question is just to understand, up to now we were in transmission assets, and now we are a little bit moving towards generation assets. So which are the risk factors you will be keeping in mind?
Yeah. So, Sunilji, thanks a lot. And I think we've already signed the agreement, so we can just describe what risk factors we have kept in mind. And also in Meghna's presentation, it was there in the beginning what we are looking at. Right? So if you look at slide 9 of our presentation, right, which kind of secure. So first is buying a good asset. And buying a good asset means that asset quality is good, constructed well. there are good tier 1 equipments in place, and therefore we have described some of the equipment name of manufacturers also, because that makes the big difference in your productivity, in your generation, in your sustainability. So that again.
The conference is now being recorded.
Just
yes, sorry, yes, that's the right one.
So from a refinancing perspective, there are no structural issues. There are largely with respect to, when you do a bond, right? It's a fixed price bond. Then it trades in the market. You can't buy them out cheaper, right? So, for example, if we issue a bond at 8.5% in 2019, okay, for 100 rupees, it is trading at 105 today, or 110, right? Now, we can't refinance that because that is a listed contract, right? We can only refinance loans or floating rate loans or something which is coming from maturity. So, therefore, we need to just maintain that calendar schedule that as and when it comes to an opportunity, we'll refinance. That's what we meant. It's refinancing.
Mm-hmm. So, in near future, maybe another 6 to 9 months, do you feel you will have reasonable good chunk which we can refinance at this lower rate?
Yes. We have sizable amount of loans which we have ability to refinance.
Great, sir. Thanks a lot and wish you very happy and healthy new year.
Thank you.
Thank you. Thank you.
Thank you.
Thank you. The next question is from the line of Mohit Kumar from DAM Capital. Please go ahead.
Yes, sir. Thanks for the opportunity once again. Is there a provision in the Poverty Koldam contract to buy out power grid?
Yes, Mohit, the provision is there. If Power Grid wants to sell and we want to buy, we can. But that is not part of the plan. Right? It's a 26% shareholding, so it's not a material in size as well.
Okay. So we can safely assume that that the dividend will keep flowing to us, and as far as if RV assets are concerned, more likely the return will come in form of interest. Am I correct?
Correct.
Secondly, sir, on the who is doing the O&M right now for the FRV asset, and is this the VGF component which is pending? Will it come to us, or it will go to the erstwhile owners?
There is a ratio.
And how much is the amount?
Yeah, so there is a ratio that we have agreed. So part of, exact numbers we have not disclosed, so probably we'll disclose on closing. A part of the VGF will accrue to us as well. In addition to that, there is also a GST claim, right? So GST payment, both GST payment and VGF, part of it will accrue to us, part of it will accrue to sellers. So we will have an upside. However, the sellers need to deliver in a particular time frame, right? That if it comes in 12 months, then you get X. If it comes in 24 months, you get Y, right? So that is the formula that we have put in place, which incentivizes seller to continue to work with us to get the claims, as well as there is an upside for us. Right? So it's a mix of both.
If I may ask, what is the kind of milestone which is still pending? Because this power plant was commissioned in 2018 and 2019 respectively.
Yeah. So for this power plant, there are certain some small amount of land, not just for power plant, the entire solar power park, some amount of land mutation pending, which is required by SECI to do the payment, which is the one milestone which is pending to receive the first VGF. And we believe SECI has already given the waiver for the first VGF. So now it is procedural. And obviously, COVID had slowed all of us down over the last 6-8 months. So now, according to us, it is procedural. On GST side, there were certain petitions outstanding in CRC, which they have, just before closing down, ruled in some other projects' favor that the GST payment will be one time and will be paid by SECI. So both these things, the material, I would say, thresholds have been crossed. And now it is a matter of procedure.
And how much is the amount pending as of now?
Meghna, would you have exact number of total GST and total VGF, please?
I don't have it offhand. Mohit, let me just give that to you later.
Sure. Who is the O&M for FRB? Is it Sterling or Wilson? And do we intend to do ourselves going forward?
We intend to continue with Sterling and Wilson for O&M for now. While we have all the managerial capability, we will have our own project manager on site. But O&M contract will continue as is because they are doing a good job.
And lastly, on the funding of the FRV, I think there is a loan amount which is taken from FMO, IFC, and IREDA. What is the proportion in which they have funded the loan, and what is our plan going forward? I believe that some of the amount is sitting as a bond from FMO.
Oh yeah. So from our perspective, we are looking to refinance all of it. And bonds have completed 3 years in the country, so regulatory-wise there is no hurdle. So we would be looking to buy out the bond and continue with that. So it will be entirely refinanced from our perspective.
From rupee loan, am I right?
Yes, rupee loan, correct. Or rupee bond, basically rupee.
Yeah, understood. Yeah, sure. Are we? I think we can raise money from bank also now, right? So our process is proving all fine. Okay.
Yeah.
Okay. Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Khyati Mehta from Tata AIG. Please go ahead.
Hi, Harsh and Meghna. Thanks for taking my question. Just wanted to have some color on the disclosures made yesterday regarding SPTL becoming one of the sponsors of IndiGrid.
Okay. So, sorry, can you repeat the question? Your question was regarding the merger of SPTL and SPTL?
Yes, and them becoming a sponsor of IndiGrid. So,
okay. So no, this is just a corporate action that has taken place. SPGVL, 100% subsidiary of SPTL, was the sponsor of IndiGrid when it was formed. However, Sterlite, SPTL and SPGVL have been merged now, and therefore SPGVL ceased to exist, and therefore the resultant company, SPTL, becomes the sponsor by virtue of merger. So this is just an intimation, factual intimation on account of that. Does that answer your question?
So, is it a co-sponsor? Because I think KKR was inducted as a sponsor. I think.
Oh, yeah. Correct. So that continues. So this is just a legal entity changing from Sterlite side. Nothing else have changed.
Okay. And the stake of IndiGrid around?
Sorry?
Of the holding of SPTL in IndiGrid would be how much as of
approximately 0.3%. Approximately 0.3%.
Okay. That answers my question.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Yeah, thanks for the follow-up, Harsha. Just one question. For H2 of this year as well as for FY22, what is the extent of refinance that we can do, and what will be the average basis point reduction in interest cost on account of that?
Okay. So, I mean, that's a question which you need to derive answer to from our balance sheet. So, on our balance sheet, we have 435 crores of bond, which is getting refinanced in Feb 21, which is getting matured, so we can refinance that. Other than that, we have a lot of project level loan, right? We have project level loan in GPTL, project level loan in ENICL, project level loan in OGPTL, right? These three put together would come to approximately 25 to 2600 crores. I will need to refer to the Q2 presentation. That three bank loans plus the bank loan at InvIT level. So put together approximately 3,000 to 3,500 crore, 3,000 crore of debt, which is at either SPV or at a IndiGrid level, we can potentially look to refinance.
And at around 150 basis point reduction on an average?
That's something which you and I won't know. As and when we do it, we'll come to know actually, right? I mean, today, I can give you the exact public numbers which we have raised, we are raising the debt now. But I think the future one depends on when we are refinancing. Right? That can be up, that can be down. So that's something we'll have to wait for when we refinance, right? It can improve as well, it can worsen, right? So don't want to give you an upfront commitment on that.
Okay, so what is the ballpark cost of debt on this 3,000 crore?
Okay. Ballpark cost of debt. I think we'll need to calculate that, to be honest, but it will be upwards of 8. That I can tell you. Okay. 8.25 to 8.5 average.
Okay, understood. And are you also planning to now remove Sterlite as a sponsor now that their shareholding is so low and they are anyways KKR is the sponsor? Is there a procedure to remove the existing sponsor as a sponsor of the company?
No, factually speaking, there is a procedure to remove by a simple vote of unit holders. We can, IndiGrid unit holders can remove. Provision is there. However, the manager board hasn't made any such decision or plan in place, so it would be premature.
Understood. Thank you. All the best and wish you and the team a very happy new year.
Thank you.
Thank you. The next question is from the line of Sunil Shah from Total Star Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. Congratulations, Harsh and the entire team of IndiGrid on this acquisition. So I have this one question, which is, I think in this acquisition we are saying that our NDCF is going to be in the range of 40 to 50 crores. I think in the course of the presentation you mentioned that a part of it will be distributed as dividend. Could you give us some sense on how much could that be and from where, how will that go about?
Okay. So I think, we can give an approximate way to compute that because we are not yet acquired, so it's difficult to predict from that perspective. But let's say, as we said, approximately 275 crore. So this asset would throw anywhere from 42 to 48 crores of dividend per year on a 100% basis, right? Considering the ROE and 15.5% cost of debt, right? And we only own 74% of this. So we get approximately, say, 30 to 32 crores of dividend from this asset, right? And divide that by number of units, which would come to about, half a rupee? Somewhere around that. Half a rupee or 60 paisa or something. Now, at a higher level, that's what the math is, right? We'll need to figure out accounting and how that gets structured and all that eventually. But on a long-term basis, there's about 33 crores of dividend on a 58.5 crores of unit holder base. Right. So that's the ratio one can look at.
Right. So does it mean that the solar assets that in future if we acquire, there could be a window through which this kind of dividends could accrue in future as well, depending on the structure. But I think in transmission lines, clearly it's not a dividend payout that you can give. But in solar assets, that possibility remains.
No, you mix the two assets. The dividend that we spoke about is for PKTCL, which is a transmission asset, but a cost-plus transmission asset. So you get a post-tax return.
Okay.
For solar, it will be interest. So it has nothing to do with the sector. It's to do with the cap structuring for that asset.
Got it. Okay, there is one more point, which is, I think there is some new discussion going around about going forward in future, government is contemplating some policy wherein if the distribution company is not able to deliver the power, there will be a penalty which will be levied. Does that anyway create any kind of business risk for us?
No. So first is that is for distribution licensee. We are a transmission licensee, so it doesn't create on us directly. Indirectly, it creates on our customers, right? Which is distribution companies. So see, all these structural measures that you keep hearing about is towards overall improving the sector efficiency, right? So while it may look like penalty is there, but eventually the government is government is only providing liquidity also to meet that penalty, right? On the other hand. So the idea is to create an infrastructure and environment so that distribution companies become more efficient, right? So that the overall sector becomes more efficient. So in the longer run, I think these will result into rather positive environment for the sector than the negative. And in the shorter run, anyways, we don't get directly impacted.
Okay. And one last question, and this is, we are talking about assets that we have acquired. But if I can get an update on the two framework assets which are in the pipeline, that is NER and KTL, could you just update us in terms of, what is the status, by when do we think that those could materialize? If you can.
Sure. So NER project is under construction, and I think it is at the last stages of construction. There has been obviously a force majeure on account of COVID and all other aspects. So there's 5-6 months delay on that project. We believe, at least what we have been informed, is that the project will be commissioned by March, and therefore we have in parallel started diligence for that. Okay. So exact acquisition date we don't know, but maybe Q4 or next 6 months. We'll look to close this acquisition 6 to 9 months as and when the project gets commissioned. It looks, at least what we've been informed, is that the project is at good stage, and then we should be able to look at it in 6 months' time. That's one can factor. On KTL, it is substantially delayed, one part of it. So 50% of KTL is commissioned and it's revenue generating. However, the other 50% is substantially delayed. So probably 12 to 14 months, maybe for that. So it will be slightly delayed than earlier plan.
So by quarter 4 of FY22, we expect that we could get good clarity for both of them.
Quarter 4 of FY22 to
acquisition
15 months ho gaya.
So we should be done with by that.
Yeah. 15 months is a good clarity. Correct. Yeah.
All right. Thanks for all this clarification, and good to hear Meghna on the call as well. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, as this was the last question for today, I now like to hand the conference over to Mr. Sumit Kishore. Thank you, and over to you, sir.
Thank you, Harsh, Meghna, Jyoti. On behalf of Axis Capital, thanks a lot for giving us the opportunity to host this call. Would you have any closing remarks, please?
Yes, I think we have been just on a track of delivering our strategy. This is a stable business with predictable returns, and now IndiGrid has good access to both capital as well as management team and asset base. And therefore, we are in a very good position to execute a strategy which was focused on, long-term contracts, low operating risk, stable cash flows, and which is what we are executing. I would reiterate, I think a year before there were a lot of questions around solar. I would reiterate that our focus is to go conservative, then aggressive, and therefore we've provided, outer caps of 20-25%. However, we don't necessarily are running to achieve those caps. We may be operating at a much lower level. We are looking to acquire, monitor, and generate the yield before we, jump onto, I would say, growing materially on especially a new sector. And it took us, I would say, about a year or 14 months from starting to think about it to evaluate, put together risk framework, build capability, and finally execute. So I would say that we will just remain conservative and focus on, the fundamental of the business, which is to get predictable, stable cash flows and generate yield for investors. Right? And I think a lot of you have been tracking us since the beginning. And thanks a lot for all the right questions, which nuances on the business, which allows you to evaluate the business better. So thanks a lot for participation, and wishing you all a Merry Christmas and a Happy New Year.